Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Waseem Daher of Pilot coming to us from San Francisco. How's it going?
I'm doing well. Thanks for having me, Nathan. I appreciate it.
Any big weekend plans? It's Friday as this is being recorded. What are you doing this weekend?
Yeah, good question. Hopefully like sleeping in, hanging out with some friends, watching Game of Thrones. That's pretty much the plan.
I'm kind of already getting sad that it's, nearing the end of Game of Thrones, right? It's
Sure.
just
End of an era.
Yeah. It's a trip to see. There was a cast photo of all basically the kids, right?
Yeah.
Arya and Sansa, like at the beginning. It was a group photo. Crazy to see, that versus today.
For sure.
Cool. Good stuff. So what is Pilot? What do you guys do?
Yeah, so Pilot's a bookkeeping company, and we actually focus specifically on bookkeeping for startups. And the way it works is when you work with us, you're paired with your dedicated account manager, who's a full-time employee of ours, who sits here in our office, is US-based. They're your point of contact. They do your bookkeeping in QuickBooks. And so superficially, we look or kind of act like any other bookkeeping firm you might engage with. But the magic or the difference is, in addition to having this amazing team that works with you, that's your point of contact, we also have an engineering team. And the job for the engineering team is to build tools that the bookkeeping team uses internally to make sure we're doing work that's incredibly accurate, incredibly consistent, incredibly high quality. So it's really people doing what people do best, software doing what software does best, taking the problem of bookkeeping off your plate so you can focus on running your business.
And what's this? I guess that makes a lot of sense because bookkeeping seems like you could write rules around it with software that would be logical. Like what does the software do, right? What part of the human experience is being replaced by software?
Yeah, it's a good question. And what's so interesting about it is that it's changing every month. In other words, every month our engineering team is constantly releasing new tools, new features that we use internally to do the work in a higher quality, more consistent, more accurate way. And so in the very, very early days, the kind of initial stuff you do is, well, maybe rules for categorization, right? When you see Lyft or an Uber ride, let's categorize that as ground transportation. Increasingly, we get more and more sophisticated and we can say, well, let's have a really tight integration with Stripe. Let's have a really tight integration with Gusto. Let's be able to exactly capture how it is your business recognizes revenue. Like the thing that's quite interesting about bookkeeping, and I realize that sounds a little bit oxymoronic, is that there's a big part of the work is like quite structured. Now, importantly, I think what our clients and what our business owners want is to have to engage with that stuff almost as little as possible. It's what they like is not that we have software that helps out here. What they like is there's a person here who knows you, who knows your name, who knows your business, who's solving this problem for you every month, so you don't have to worry about it.
Good. That makes sense. And is it just a subscription basis or are you paying an hourly rate or what's the model?
Yeah, great question. It's priced like a SaaS service. In other words, it's a flat monthly rate that's a subscription.
Cool. Very good. And were you an accountant? Where'd you come up with this idea? Were you
Yeah. So this is the third startup for me and my co-founders. We were actually all in undergrad together, and then we did these two companies prior to this. So we've known each other for like 15 years. We've worked together professionally for like 11, if you don't count class. And in our previous companies, we were our own bookkeepers. Mm-hmm. And in doing the problem, we just very viscerally felt the pain because our backgrounds were all computer science. So in like sitting in front of QuickBooks and clicking around, like we sort of had this agonizing feeling like, a lot of this stuff, like we should have software that's doing it. And so it was born out of pain that we very acutely had. In fact, in our very first company, we had sort of hacked together some scripts to help us out, just that we'd written on the side to make our lives easier, to make the work more accurate. Mm-hmm. And I think thinking back on that, we're like, well, we're not the only ones that have this problem. Like every company in the world has this problem. The solution today is incredibly manual. Like, why is that? It feels like we can be doing this better.
Yeah. What were your other companies? What did you do before?
Yeah, so the first company we did was this company called Splice. And the premise of this company is we had some technology. It was actually the master's thesis of one of my co-founders. It could take, that pop-up you get that's like, you must reboot, install new updates. We had some technology they could take those updates and transform them so you could apply them on the system while it was running without the reboot. And the idea was this is less about like your laptop or your desktop. It was more about server infrastructure, where you want all of the benefits of having the updates applied, but you don't want to incur the cost of the downtime. And we actually bootstrapped that company. We operated the company in Boston, and we ran it for about 3 years. And then Oracle acquired it. They wanted to sort of embed the tech into their Linux offering. And then the second company we did was this company called Zulip, which was a group chat tool for businesses, sort of targeting a market that really is dominated by Slack today. For that company, I would say we did an A+ job identifying the market opportunity. I think I would have to, in fairness, give us a C on execution in that it didn't become Slack. But it was acquired by Dropbox, and we spent a fair bit of time at Dropbox on the product and on the engineering side before starting this company.
Interesting. Is the product still alive within Dropbox, or did they acquire the team? Or if you're,
It's interesting. It's interesting actually. So what happened is that Dropbox ultimately open sourced the code base, and one of my co-founders from the previous company has now built another company around that open source code base. So he's kind of keeping it running.
Interesting. Okay, good. I had one of these podcast interviews yesterday with a company called Threads that is different. I'm sure they will argue it's different. It is different, but it's in the same general category as Slack. So it's interesting that people are still sort of aiming at that space, even though Slack is the big gorilla in the space, right?
Yeah, it is really interesting. I mean, I think one of the things that is true about these large markets is I think they're not winner take all. In other words, I think Slack is a great product actually, but I don't know that it's the last word on how this stuff should work.
Yeah, very interesting. Cool, great. And you guys have been around how long with Pilot?
Yeah, we started this company in December 2016, so a little over almost 2.5 years at this point.
Okay.
Yeah.
And how much have you raised?
We've raised about $59 million.
59? Oh.
A fair amount.
Yeah. Over how many rounds is that?
3. We did a seed round immediately upon starting the company. This was sort of early 2017. And then we raised a Series A. I guess the seed round was $3.3 million. The Series A we did in early 2018, which was a $15 million round. And then quite recently, we did a Series B that was a $40 million round.
Wow. Okay, great. That's really quick, and that's exciting. So I want to get into it. Let's take it chronologically. The seed round sounds like you kind of had this, you said you raised it basically right away. How did you put that together? And I think I kind of have a clue because I see some of the investors like Drew, is it Drew Houston or Drew Houston?
It's Houston.
Yeah.
Mm-hmm.
So did you just kind of corral some folks you had worked with, or you tell the story?
Yeah. I mean, what's interesting is, so because this was the third company for us and with the same founding team, and that we had these 2 exits in the past, what was nice is that we had a network that we could leverage for this. So really what happened with the seed round is we called up a bunch of folks and we said, hey, we're getting the band back together. We're doing a new company. Do you want to invest? And it was not quite that simple, but it basically was. It was, are you interested in taking a bet on this team, a team that you know, because we've worked with you in some capacity, a team that you know is good. And I think, for those seed investors, it was really conviction in the quality of the team that they were writing the check for. And then from our side, the way we did it this way is there are people that are seed investors in our company that honestly I would have paid to get advice from. And so actually having them give us money and give us advice and give us some help was, I think, a no-brainer. It was actually a fairly big seed round in terms of the number of investors. I think it was 40 or so folks.
Really? Okay.
Yeah.
Did you do a note or safe, or what was the format?
Yeah, it was a safe. Yeah,
cool. Why did you choose safe over a note? I mean, it seems to be popular these days, but what was the thought?
It's a good question. I think, you're right. That's basically, it seems to be in vogue out here in San Francisco. I mean, there are some technical differences, but I actually don't think that they're particularly interesting. I think in general, the way I think about those sort of early transactions is how can you structure it in a way that just makes it easy to get done? Ideally, in your first round like this, it's just, okay, we agree on the high level terms. Let's shake hands. Let's get it done. And we don't want to spend a bunch of time going back and forth with you about, well, what is the exact document we're going to use?
Yeah. Did you have any working prototype at that point, or was it really based on this getting the team back together?
Well, so it's a funny thing about our business, which is, we have all these engineers and product managers and designers, and they're building a bunch of stuff, but that stuff is largely invisible to our customers. Meaning when you work with us, again, you're paired with this person here who does all your work in QuickBooks, and they send you email, you talk to them on the phone. So literally on day one of the company, I called up some people in my network that I knew had companies, and I said, hey, who's doing your bookkeeping? And they'd be like, actually, no one. We're looking for a bookkeeper. And I said, well, congratulations, I'm your new bookkeeper. And literally, I did the books for our first customers in QuickBooks Online, just like any other bookkeeper would. So even though we, of course, have built a bunch of software, from that point to now, what's interesting is the customer experience has actually remained largely static, largely unchanged. And the reason I said all this is actually, at the time we raised the round, it was really about the team and the belief that, oh, this team can actually take a differentiated approach or solution to this problem. It's not that we had made a ton of progress building out infrastructure at that point.
Yeah. Did you have you were doing the bookkeeping, but did you also have to get some accountants or bookkeepers in the team to help guide the product? Or?
I mean, definitely. Yeah. I think it's one of these things where our team is a funny team in that I think historically you have your team of kind of smart accountants and finance people over here, and you have your team of like smart and talented engineers over here. And these two worlds generally don't particularly mix. Like even when we were at Dropbox, the finance team sat over here and the engineering team sat over here, and the finance team was doing stuff that they knew very viscerally, like, oh, I just wish we could just like get, one of those engineers and she could really like, help us out with this. But just like that generally doesn't happen.
Yeah. Right.
And so we are kind of a funny company in that we have been able to get the sort of oil and water to mix with, talented folks with strong finance backgrounds and obviously a talented engineering team as well.
Cool. Great. Yeah. I see a few other names here that I recognize, like Adam D'Angelo.
Yeah, from Quora.
Quora. Yeah. How did you wrangle in Adam? I'm sure that he's got a lot of good advice for you.
So he does. He's terrific. I mean, all of the folks that are, these angel investors, again, for us, it was, I would literally have paid you money to advise us. So to have you invest some money and give us some advice was just like very, very much a dream. For almost everyone on that list, it really was a pre-existing connection. And I think the story with Adam in particular is that, and this is like kind of funny, I think he went to like, I want to say like math summer camp with one of my co-founders, like in high school. And so like they have known each other for a very long time. And Adam has been following along for all three of our companies. I remember in the very, very first company, Adam came by our office one time and gave us some advice from his early days at Facebook and his time at Quora. And so for a lot of these folks, it's really that they had been following along. And therefore this was, oh yes, I want to get behind the next thing these folks do.
Yeah, that's great. With these kind of, almost call them celebrity angels. I mean, these guys are running big companies on their own. Can you get much time and attention from them? Or is it, the credibility of having them on your team? Yeah,
that's a great question. I mean, I think generally, no, you can't get a ton of time for them. Meaning, they'll take your call, but you cannot, I'm not on the phone with these folks, every week or every month. I think you have a limited number of bullets you can fire when you really need something tactical from them or something strategic from them. And they're super willing to help. It's not that. It's just, of course, that they're busy. I think one of the things that we observed about our angel round, both in this company and then also in the previous company is, we added a lot of people to the cap table. And I think one of the things I strongly, I have a lot of conviction about at this point is 10% of the people that put in money are going to be really useful to you. And the other 90% are just going to do nothing. The problem is you actually don't know which 10% it's going to be. And so in our previous company, actually, we had raised an angel round, and there was one person who approached sort of towards the tail end of the process. The round was kind of already done. I was not that excited about letting them in. It's like, well, we're kind of, I don't know. It doesn't seem like you're going to really be able to do that much for me. We're kind of, we're sort of finished here. And my co-founder was just like, well, it's just, let's let this person in. Who knows what could happen? And that person, I was so glad that we did, because that person was literally more helpful than all of the other angels combined. And he's an investor in this company. It's just like the relationship has paid huge dividends, both at that previous company and at this company. And we almost didn't let him invest. And I think that's the takeaway for me, which is it's hard to know who's going to add value in advance.
Yeah.
And I think a lot of people, they say don't have these huge cap tables, don't have these huge party rounds in the seed round. I personally don't think it's a huge deal. In fact, I think it has benefited us a fair bit.
Do you do anything to manage or engage them? Do you have a regular investor update or newsletter or throw a quarterly party or I don't know?
Yeah, we would send out a monthly update email with like, okay, reminder, this is what the company is. Here's our ask for you. And, here's some updates on how the business has been progressing.
Yeah. Good. Yeah. Great. All right, let's go to the next round, Series A. So that was 15 million. Who led that round? That was a proper VC round?
Yeah, Index Ventures led the Series A.
Now, they're based in the UK, right? Or are they?
It's interesting. They have a San Francisco office, and they also have a quite big European presence.
Okay.
Yeah.
So for raising that round, how did you land on them? And did you run a process, talk to lots of folks? What was?
Sure. So it was a bit of a nail biter, to be honest with you. So in the seed round, actually, just to provide a little more context, in the seed round, we had taken a little bit of investment, a little bit of institutional investment from 3 VC firms that, we'd sort of known some folks there. We said, okay, it might be interesting to have them follow along.
Yeah.
We don't want them to have a huge ownership stake necessarily, but we do want to keep them engaged. And I think the thinking on that count, on that number of 3 is, it's going to give us some optionality. It will make it, we don't have to run a fully fledged process, but we'll have a couple different firms that will be well primed to do the Series A when the time comes, because they will have been getting the investor updates, they'll have been following along, et cetera. And so we raised the Series A really in early 2018. And I think we raised it from a real position of strength, which is that we didn't need to raise then. In fact, we weren't planning on raising at that time at all. But one of our investors had approached us, and they said, "Listen, we're really excited about this company. We'd like to put in, we'd like to do the Series A. What would it take to do the Series A now?" And we said, "Well, we really want to get the metrics of the business in a better place. Like, we raised a big seed round. We don't really need the cash. Things are trending nicely. Like, we don't think it makes that much sense to do it now, unless you're willing to give us credit for sort of where we would get with the funds that we currently have." And so I think this is a theme that you hear a lot on this show, actually, which is the easiest time to raise money, or the easiest way to raise money, is if you don't need the money.
Sure. Yeah.
And so we went back and forth with that investor, and we basically said, like, we tried to settle on, what is the buy it now price? Like, what is the offer that if you made it now, we'd just say, yeah, let's pull the trigger on it. Like, let's just get this thing done. Even though we don't need it now, we're willing to accept it because it gives us credit for where we think we could get.
And by that, you're talking about valuation or terms, or both, or kind of like?
I mean, the terms generally, amount raised and valuation are quite tightly linked. Yeah.
And you said they kind of approached you and they said, "We're really excited about this." What were they excited about? What kind of made them want to sort of swoop in and preempt it a little bit versus waiting for you to come back hustling?
Yeah, well, again, I think we have some unfair advantages here, which is the track record of the team. And so we had continued to build out the team. It's just, I think if you talk to folks who were familiar with the people who had joined, it was clear that we were building this like real talent powerhouse where we just had these amazing engineers. We had these amazing product people. It was just, I think people were seeing, wow, really, really strong team tackling a quite big market opportunity.
Yeah.
And in particular, one of the things I say about our business that I actually really like is that superficially it sounds really boring. And I think because it seems boring, and I mean, look, that's definitely how I felt about this before we started this company. The fact that it seems boring is actually what makes it really interesting, because it means there's a lot of low-hanging fruit. There's a lot of opportunity to really build something that's 10x better.
Yeah.
And that lots and lots of people need. I mean, if you think about any business, the question I always have is, okay, who are the potential customers? And is this a nice to have or a need to have? How badly do they want this? And then how much does it cost? So for us, who are the potential customers? In principle, at the full scale of this business, it's literally every business in the United States every business in the world, has to keep its financial records.
Mm-hmm.
How badly do they need it is a nice to have or need to have. They're basically legally required to do this. I mean, not literally, but functionally, every company effectively has to do this.
Yeah.
And what is the alternative to working with us? Well, you're hiring a bookkeeper somewhere, and that's skilled labor, and so it's expensive. So you have a lot of people who need the thing very badly, and they're willing to spend a lot of money to have the problem solved. Like, you multiply those numbers, you get this huge market size. So I think that's the combination of, one, that, two, the team, and three, this idea of the fit between the team and the problem. Meaning that, we had this thesis, and we have this thesis of, we can do really high quality work if we are able to push a lot of this stuff into software. If you look at the team, you're like, oh yeah, this is a team that's definitely capable of engineering and of building this product.
Yeah.
So I think for us, the Series A was really candidly on the strength of the team, the vision, and the initial attraction. Just like, yes, our customers did loved what we were doing. We were adding customers at increasing rates. Like, initial signs seemed promising, but just to be very candid with you, it's not like someone said, oh, let me take your revenue number and multiply by this certain amount to get to this valuation. It was really a bet that, like, I have a lot of conviction that this is working and that it will continue to work.
Yeah, cool. That makes sense. Mm-hmm. All right. How about the B? Let's go ahead there. So what was the situation at the B? And that went pretty quickly after the A, right? Relatively?
So actually, let's stay on the A for 1 second, actually, because there's a twist here, which is, so this person came to us and they said, hey, we went back and forth with them. This is the offer we'd like to make you. If we did, would you take it? And we evaluated. We said, yes, this sounds really interesting. Let's do it. And then this person said, great, come to our partner meeting on Monday. You'll present. Like, you'll just come hang out here. I'll come with a term sheet immediately afterwards. You'll sign it. I'll open up some champagne or whatever, and you'll get back to building your business. And we're like, great, super easy. We've shortcutted this whole process. It's going to be terrific.
Mm-hmm.
And then in the back of our minds, we're like, well, look, we don't want to run a whole process here. The whole point of doing this was to shortcut the time and hassle and effort of doing this. But we have these other investors that were in the seed round. Like, we should probably at least give them a heads up that this is coming. Like, I think they might have found it a little bit rude just for this deal to have happened with them having no shot at it. So we said, look, we're definitely going to take this company's offer, this firm's offer, but let's tip off our other guys just so they know what's going on. So we met with the other firms too. We said, hey, listen, we just spoke with firm XYZ. They're going to produce a term sheet for us on Monday. These are the terms it's going to be. If you're interested, you got to act now. Like, this is happening. You can thumbs up if you want in, or you can thumbs down if you don't, but this is moving quickly. And so that kind of started to catalyze the process with some of these other firms too. And they said, oh, we'll come to our partner meeting on Monday as well, because, like, we also want to give you a term sheet. Like, we don't want to let this one slip away. And actually, ultimately what happened as the dust settled is we went to like 3 or 4 partner meetings that Monday.
Wow.
And the first firm, this is the part that was crazy to me, the first firm actually did not produce the term sheet. The partners met, and we were sitting in that room waiting for the term sheet to come, and like 15 minutes went by, and like the person wasn't there. And like 30 minutes went by, and like the guy still wasn't there. And then we were like starting to get nervous. We're like, I don't know.
You're sitting in the lobby?
We're sitting, like, they put us in a conference room. So it was fortunately not the lobby, but it was like a little room, and we were just like, we thought it was gonna be 10 minutes. Then an hour later, the guy comes back and he's like, hey, listen, I have some bad news. Like, I'm super excited about this investment, but the partnership, like, they have some reservations. Can we spend some more time on this? We might be able to get you something tomorrow. I'm not sure. Like, it went from being, this is a sure thing done deal to, I can't make it happen. And I think the thing that was unexpected for me is this person was a partner at the firm.
That was my next question. Yeah.
Yeah. So I would have naively thought, well, this person has the power to get it done. But the reality on these firms is, like, the power dynamics are much more subtle and much more complicated, even among the partnership. There are partners who can make the decision. There are partners who cannot. There are partners who can veto. Like, even the thing that we thought was a totally buttoned up done deal was not.
Yeah.
And so fortunately, though, what was interesting is that firm ended up setting the price, and other firms did in fact produce term sheets with those terms. And we really liked the folks at Index. So we had actually interacted with many of them from our time at Dropbox. A bunch of people that were there were formerly employees at Dropbox while we were there. So we're like, great, They're terms we like with a firm we really like, let's get it done. But it was really scary because there was that moment from when we thought we were going to get the term sheet and we didn't to, well, is anyone else going to make one? Like, what if they don't too? And now we were out there and we told everyone that we were trying to raise money and that it wasn't going to happen. It's just like, we were quite nervous because it could have set the whole process back. I mean, potentially 6 months.
It's a great story. It's a great story. And so your next meeting, you had to leave there knowing you had sort of been delayed or rejected or however we're going to frame it. Your next meeting, did you then say, did you tell them that we don't actually have a term sheet?
No. Yeah. I mean, and for two reasons. One, obviously, is like, no, that it doesn't benefit us for them to know that. And the second is just, I think above all, you know, your honesty and integrity is key to this process. Everyone is talking to everyone else. It's not like you're really going to be able to fool the other investors. I think you have to be candid. And the reality was, you know, the firm said they were going to think about it and they were going to produce a term sheet. Now, was it going to be on the exact terms that they initially like really swore up and down to us that they would be? Like, no, probably not. But I don't know that.
But that must have just been nerve-wracking because if they had asked, right, the second firm or third firm had asked, I'm sure you would have told them, you know, the situation, and I can see that tainting it, the momentum maybe a little bit.
Right, because it's like, what does this firm know that we don't know?
Yeah.
Why didn't they decide to invest? You know, what concerns did they have? And should we have those same concerns? The whole thing, it was funny because it was like we had such momentum and it was like, oh, great, we're just going to get it done. And then at the last minute, like it looked very scary, like that it was all going to fall apart. And I think the takeaway for me, and again, it's obvious in retrospect and people say it, but it's sort of one thing to experience it, is it's not done until it's done.
Yeah.
And I think that even past the term sheet stage, which is, yes, you have the term sheet signed, but like it's not done until the money is in your bank account.
I tell founders that all the time. We do a webinar called Funding Hacks, and that's one of my key things. It's like, how do you know a VC says yes when the wire clears?
Yeah.
Good. Okay, very interesting. And did the first firm end up coming in on the deal as a co-investor or no?
No. Well, so the way we had structured the round, I think the firms that were interested in participating were all interested in really basically buying most or all of the ownership.
Yeah.
So in the Series A, it was a $15 million round, of which 12 was from Index, and then 3 was from another firm called Authentic Ventures, which we had gotten friendly with.
Got it. Yeah. Cool. Good stuff. Good story. Great story.
Yeah.
All right, let's go to the B. So tell me about the process there and dynamics, and if there are any good stories around there.
Yeah. So again, I think the thing on the B was when we were raising the B. Well, let me rewind. You know, late 2018, early 2019, our business was one where, sort of like a real business, we charge you for doing work for you. So we have a fair bit of revenue coming in, and of course we have a fair bit of expenses going out, salaries, et cetera. But the company, you know, there's a fair bit of, you know, money exchanging hands here. And as a consequence, I think by the end of 2018, we had finally finished spending the seed round. So we still basically had the whole Series A still in the bank. So our cash position was super good. It's like we still had that $16 million like in the bank. And so people were starting to reach out to us and say, well, you know, should you think about raising a Series B? Like, should you raise another round? It's been about a year. And our opinion was, well, we don't need to. We still have that whole Series A still here. So again, like, no, I don't think it makes sense to, but let's have some casual conversations just to update folks that we think might be contenders for the Series B. And I think there's really a tension in raising money where on the one hand, you want to execute like a very time-bounded, tightly like run process. And I think that's true. But I think the other thing that's true is it's hard to swoop in with a firm that you've never spoken with, that you have no relationship with, and be like, you have 72 hours to decide whether we're going to like spend the next 10 years together.
Sure. Yeah.
Because these things are like real, like long-term, high stakes, like relationships and commitments. And in particular, that's one of the things we felt very strongly about, which is it's not even about the firm. It's about the partner at the firm, because that person's going to be on our board. Like I'm going to talk to them all the time. Like we are really in business together for the next 10 years. So I optimize less for what are the specifics of the deal and more about, do I think this person is going to be a smart, thoughtful partner to us in helping us build our business? Do I think they get what we're about? Do I feel like we're on the same team, et cetera? So in the spirit of that, we said, well, let's have some casual like coffee updates for these folks that I think actually we probably had last spoken to probably around the time of the Series A. Like it had been sort of a year, since we had given them a real substantive update. So we said, well, let's sit down with a couple of these folks. Like, let's just tell them, hey, this is the current state of the business. These are the metrics. These are how they're trending. Just so they would follow along and give them our prediction for what the next year is going to look like. So that when we finally do come back and ask them for money, we can say, well, we told you we were going to do X. Here we are. We did X. Now we want to do Y. And to do Y, we need, amount of funding Z. And so sort of demonstrating over time this kind of track record of credibility, but also meaning that you didn't have to get thrown into the deep end all at once, that you had some context to understand the business and the team and the market and the traction, just like to give you sort of more time to have it sit well with you. So in early 2019 and late 2018, early 2019, we said, okay, we should probably, start to have some conversations of these forums since it had been a while. And the second thing that had happened too is that our partner at Index, Mark Goldberg, who was on our board, who obviously was following along very closely because he's on the board, like we do the monthly updates, et cetera. He said, listen, I really, really like the way this is trending. When you folks think about raising a B, like, let me know. I would love for Index to double down. And so again, I think it's one of these, like, it's easiest from a position of strength things where we had the money, so we didn't need more money. And we had this vote of confidence from our existing investor that said, I'm interested in putting in, I'm interested in adding more money to the business.
Do they want to lead, or just they were saying, we'll double down, so you have a follower? Basically.
Yeah, they wanted to lead the round. I think they would have been fine either way, but I think their desire was to lead the round. And Mark, I think very thoughtfully, in a way that I appreciated, was saying, well, what's in the best interest of the company? Like, yeah, maybe you should talk to some other firms, but like, know that we at Index are prepared to lead the B when you think strategically it makes sense for the business. And so I think armed with that, those coffee conversations we had with some of these other firms, like, I think they also saw some of the same things Index saw. And again, the tenor of the conversation was, we don't need to raise money now. In fact, we may raise that money a year from now. And I think the thing that was going on in their heads was, well, can we preempt this? Can we get into it sooner by writing the check now? And so again, that whole, like, as momentum started to build, we went back to our partner at Index and said, hey, listen, there's actually more interest from these other firms than kind of we had sort of imagined or anticipated when we're having these coffee updates. It feels like something's going to happen here. So you'd mentioned you folks wanted to participate in the B. If you do, like, now's the time. Like, let's do the partner meeting. Let's have you produce a term sheet. And so they did. We went to the partner meeting. They did produce a term sheet. And that, of course, kicked off our mini process again, where we went to the 4 or 5 other firms we were speaking with. And we said, hey, we have a term sheet from a top tier investor. If you folks are interested, now's the time. And I think one of the dynamics that one of the deal points that was sort of being figured out is like, well, what is the right amount raised? What is the right valuation? And our initial investors had led with a particular proposal. And then I think as they saw that we were getting some traction in these conversations with other investors, they said, oh, well, actually, maybe we need to revise this proposal to make it more generous. Like, Mark and I had a conversation and said, well, what is the offer we could produce now that would cause you to just take this off the table and not run the rest of your process? And first of all, is there such an offer, and what would that look like? And we went back and forth. I said, listen, we love working with you folks. We love that you believed in us in the A. We would love to have you as partners in the B. That this is the deal that would get it done. And this was like a text, some late night phone calls, that kind of thing. And then, they had enough conviction to get there, and we said, cool, let's do it. Let's raise the money and let's get back to work.
It's great. That's such an enviable position to be in. I guess
Sure.
I'm still, if you had already the advisor in Mark, right? You already had the brain power helping you out, and you already had the money in the bank. I guess still, what was just because it was there, and so you didn't have to do this later? Like, why did you need to do it if you didn't need the money, didn't need the brain?
Sure. It's a good question. And I think there's a difference between this is going to sound a little silly, but I think there's some truth to it. Is like there's a difference between needing the money and like wanting the money. And I mean that not like, oh, we're greedy, we want the bank account to have a bigger balance. But I think the more well capitalized the business is, the less likely you are to starve the business on things you should be doing that you might not otherwise be willing to do if you didn't have the cash. In other words, so this, we raised that $40 million round, having $15 million versus having, the 45 or 55 million at the end of that process. Does that embolden us to take bigger bets that we might otherwise, if we only had 15, that we might not otherwise be taking?
Yeah.
Like, can we hire more aggressively? Can we pour more money into growing the sales and marketing side of the business more aggressively than we would if we had felt more cash constrained? So I think for us, it's almost psychological. It's, can we really give ourselves the conviction to put our foot on the gas pedal to really grow this business? Was kind of part one. Mm-hmm. And part two was, these things are quite sensitive to the macroeconomic climate too. Better to have the cash than not have the cash. Like in the event that there is a downturn or there is like more apprehension in the venture capital industry, like now or at the time we raised capital happened to be a particularly good or comparatively easy time to raise money. Mm-hmm. In 6 or 9 months or a year when we were planning to raise money, would that still be the case? Who knows? So I think our view was sort of, well, if we're going to get credit for where we would be able to get with the funds we have, why not take that deal now rather than 6 months or a year from now?
Yeah. I hear you on the macro thing too. I think about that, whether we should get out and raise some money right now.
Sure.
Just as sort of a hedge. Do you worry though about having, startups make the mistake of spending frivolously when they have too much money? That you've seen that kill startups. It sounds counterintuitive, but it happens all the time. How do you maintain some discipline when you have so much money to put to work? Yeah.
100%. I mean, I think there are the challenges of raising too much money are when you have a lot of money, you're tempted to spend it on stuff that actually isn't important. And then also you're raising the stakes on the next round. You're requiring that you get to certain milestones or thresholds that had you raised at a lower valuation or had you raised less capital, like the pressure would not be on so much to do that.
Right.
I view those 2 points a bit differently, which is for the first one, and maybe this is just we have overconfidence in the quality of governance that we sort of have internally, but our first company was one we totally bootstrapped. And I think, we run the company in what I consider a somewhat East Coast way, where we actually we look at these numbers. We're like, okay, what is our revenue? What are our margins? What is our cash burn? Like, where is this money going? Are we getting good ROI on it? Like, if anything, I think our natural predisposition is to be too frugal. So I think that's very specific to this founding team, though. Mm-hmm. So yeah. I felt like we were less likely to fall into that trap than a different type of business. And also because our model is, it's functionally, it's a B2B SaaS company. So I think it's a little bit clearer, a little bit easier to measure, okay, when I spend X dollars, I'm getting Y revenue in return, as opposed to, well, I've just bought 100,000 users and I don't really know what those users are worth, but maybe someday we'll be able to monetize them.
Yeah.
I think that was sort of piece one. And then for piece two about it raises the stakes. Yes, that's true, but we're aiming really, really big with this company anyway. So I think tying ourselves to the mast of, no, you really have to do it. I don't know that that's necessarily bad. I think it's like a little bit of the burn the ships approach. It's like the team is very motivated to getting to those next milestones because we have to.
Yeah. Good. And I see a couple more questions. I'll let you get back because you've got some milestones to hit, my friend. I see Stripe put some money in. So do they have a venture arm, or is this investing off their balance sheet, or what's the deal with that?
Yeah, it's a good question. I know less about the details of the specific legal structure, but I know Stripe has, as of recently, made a couple select investments in various companies, generally kind of in the fintech or fintech-ish space. And so we were super excited to have them in the round. I mean, for many reasons. One is, so Patrick and John were angel investors in the company. I've known them for a very long time. We obviously think very, very highly of the business. When we look at companies that we consider like real inspirations for us in terms of how they've built and grown their business, we look at companies like Stripe. We look at Gusto actually as another example of a company that I think has done this really well. So for us, it was actually similar to the theory on the angel round. It was like, well, we would pay money to have access to the advisors and the resources and like the super smart people over at Stripe, if they're willing to give us money and then also hopefully be more inclined to help us out when we need help on certain things. Like, great. That sounds good to me.
Yeah. I guess you'd call them a strategic money. I mean, is there a partnership arrangement as well? Is it just you guys are sort of, I see the synergy, although I don't. Yeah.
It's a good question. I mean, the way that my understanding of the way they structure this internally, and again, I'm sort of an outside observer like you are. I think they really think about investing purely for financial returns, but they like to do so in companies where they think they can be particularly value add. And so for us, we also view it as like a really nice endorsement. It's like, wow, okay, the team at Stripe thinks that we are uniquely onto something quite interesting here. Like, that's nice market validation. Hopefully that carries some weight with customers and potential customers as well.
Yeah. No, it's great. Great logo.
Yeah, for sure. For sure. Very happy to have it.
Very good. All right. Well, maybe one more question. Anything we haven't covered, anything you would do differently if you were repeating this process again, or for your next round, or any other advice?
It's a good question. We have sort of shied away in all of these fundraisers from doing the like huge process with, the 50 firms or whatever. And I don't think there is a right or wrong way to do this, in the sense that what really matters is, did you raise the money your company needs to survive? And if you did, you succeeded. And if you didn't, well, then you didn't succeed. And I think the exact path to that, like, it depends. I think it's quite situationally dependent. For us, we have been incredibly fortunate in that we had a lot we could take advantage of. We already had these pre-existing connections. And I realize that that's like special and quite unique for our company. And as a consequence, I think we were able to run a much, much more limited process because we had these pre-existing connections. I think the thing that I encourage folks to remember, or that I try to internalize, is, yes, it feels like a transaction, but it's not. Like, everyone in this process is like human and fallible and has emotions and like wants to feel wanted and like needs to be warmed up. And I think like remembering that there is a real human side of the transaction, that it's not just, okay, we're running an auction and let the highest bidder win.
Yeah. Good point. Good. All right. Well, very good. If people want to learn more, it's pilot.com.
Yeah, pilot.com.
It's funny. You're like the third one of these I've done recently where I'm always actually impressed by this domain. What was Pilot before you guys came along? I assume you had to buy it.
Yeah, we could spend a whole other hour talking about this story. In brief, it was owned by Hearst, the magazine conglomerate.
No.
And I think they had bought the domain because they intended to develop it into some like a web property of some kind, but they never did. And we hired a domain broker who was able to just like get it out of there, which was, we could spend a whole hour talking about this. We were really happy to have the domain just because you're trusting us with your financial records, right?
Yeah.
So having the domain be like pilot.com, like, wow, that's a premium domain. This company must be real. I think it was important for us.
I wonder, so you don't have to give any names, but was this broker referred through like the Y Combinator network? Because I had the same conversation yesterday with Threads. I was like, wow, you guys got Threads. What a great name. He's like, I guess there's a domain whisperer that.
I mean, it's funny. I know the Threads people.
Okay.
I don't know if we use the same guy. I'll have to check. Yeah. This one was like an old college friend of mine had sort of first introduced me to this guy.
That's cool.
Yeah.
Cool. 5 figures or 6. You don't have to answer, but
Oh, 6.
6. Okay.
Yeah, it was expensive. It was very expensive. I mean, this is to my point though, actually, about when you have more capital, you're emboldened to do things that would be good for the business that if you didn't, you might not have. Like, we raised that $3.3 million seed round as opposed to a more modest seed round. And I think had we raised a $1 million seed round, I don't know that we would have been willing to open our wallet for the 6-figure purchase that was the domain. But I think it was super important for us to do that.
Yeah. That's a great name. All right, Waseem, this is super good. So if people want to learn more, pilot.com, and startups, I mean, there's no minimum size of the business that anyone can sign up, correct?
Yeah, and in fact, startups are really our bread and butter. We do bookkeeping for technology companies ranging from 2 people all the way to companies that have hundreds of employees, Series B, Series C, and beyond. And we have a special promo for Founder Suite listeners. Yeah. If folks go to pilot.com/Founder Suite, one word, they'll be able to get 20% off their first 6 months on our Pilot Core plan.
Awesome. Pilot.com/Founder Suite, 20% off first 6 months.
Exactly.
Wonderful.
Perfect.
Cool. Thank you so much. We'll catch you. I
me.
usually say we'll catch you after your B round, but you guys are off to the
next. We'll talk again next one for sure.
All right. Thank you. Have a great weekend.
Thanks. Talk to you later.
Bye.